All right, good morning and welcome to this program for the University of Arkansas Small Business Technology and Development Center. Today, we are happy to present these educational programs to help support small businesses in our local area. Like I said, we are recording today's webinar for educational purposes. And as an attendee of this webinar, you will be emailed a copy of this presentation used, and this recording will be on our website later today at ASBTDC@uark.edu. Well, so my name is Jay Seago, and I am a business consultant here with ASBTDC. And I'm here with our presenter this morning, Scott Lacy. Scott will be introduced here in a second, but what I'd like to talk about is our Small Business Development Center. We are a one-stop shop for startups, existing businesses, and we're associated here with the University of Arkansas and affiliated with Small Business Administration and a statewide group of ASBTDCs, as well as a nationwide network that consists of well over 1,000 small business centers across the country. Locally, we offer free one-on-one consulting and programs that are very similar to this, covering relevant topics for business owners. And if you're not already a client, I'd encourage you to visit our website and sign up for a free consultation. Today, we're bringing you the webinar called Small Business Vitals. And this is the first in a series of our fall financial series. This webinar is with Scott. It's going to be presenting for 30 minutes, and then we're going to close with a 10-minute question and answer. Please post your questions for Scott in the chat, or you can save them for the Q&A at the end. Both of us will be monitoring and facilitating your questions. At the conclusion of the presentation, we'll address these. You have the ability to be anonymous via the Q&A, but not in chat. And again, we're going to be monitoring both of those, and please ask that you hold those questions if you want to bring those up at the very end. So now I'm happy to introduce my good friend and presenter, Scott Lacy. He is one of our business consultants here, and he is our financial expert. Scott's been an entrepreneur for over 10 years. He has conceptualized, launched, and operated 2 businesses. During that time, he's consulted with other small businesses and startups in the area, and his areas are business strategy, financial analysis, and capital fundraising. So welcome, Scott. Over to you, buddy.
Thanks, Jay. So good morning, everybody. Jay just mentioned a little bit about me. I want to let you all know that my email is listed here on the screen. If you want to get in touch to talk more specifically about your business finances, or if you have any other questions that we might not get to today, I'm happy to talk to you about that. And you can just register on our website for a consultation if you're not already a client. My email there is just sl072@uark.edu. And as Jay mentioned today, this is the first class or the first webinar in our fall financial series. So really glad to have you guys here. We're going to have several more throughout the fall. So be on the lookout for those on our website or the newsletter if you're signed up for that. So with that, we'll go ahead and get into things. So this is the agenda today. My goal for today was really to be able to cover, these 7 items that are all things that I'm hoping you're able to implement very quickly as soon as we're off of this webinar, but things that are also very vital to every business. These are things that I go over with almost every new client that I have that have direct impacts on their businesses and potentially on your business as well. So hopefully most of these things you'll be able to get off of this webinar today and immediately go and implement, or at least start thinking about and making some progress towards within your business, so you can have some immediate change. So the first thing we're going to go over is a business dashboard, and then accounting, gross margin, break-even analysis, some cash management, accounts receivable, age, and then budgets, forecasting, and tracking. And I've got they may all sound a little bit complicated, but I've simplified them enough just to hit the basics today to where you can get going. So first things first, the business dashboard. So in every area of life, or most areas of life, or especially professions, everyone usually has some kind of dashboard or monitoring system. And the example that I love to use is, pilots flying an airplane. We've all seen the images of a pilot being in a cockpit and they have, hundreds of gauges that they're looking at to help them fly, the speed, their altitude, the outside temperature, all kinds of different things. And the majority of the time, they're actually not looking out the front window and flying. They're looking at their instrument panel to fly the plane. It's the same thing for ship captains. It's the same thing for doctors looking at charts for a patient when they're taking their blood pressure or their heart rate. There's all these different metrics that people use in all these different professions to kind of fly their plane, whatever it might happen to be. But what we find in the business world, especially in the startup world and the entrepreneur world, is that very few business owners know that a dashboard actually exists for them to be able to use to fly or to actively manage their business the same way that people do in other professions. And so today I want to begin to give you the beginnings of developing that dashboard so that you have more than just one or two metrics to look at to manage your business. The metrics that business owners typically look at in the beginning stage of their process are their bank account balance and their sales. And most businesses today are managed by just using those two metrics. And most businesses that go for a long time by only using those two metrics wind up failing or not doing nearly as well as they could have. So today I want to begin to give you the start of that dashboard so that you can actively fly and manage your business well to get the most out of it that you possibly can and achieve your goals. So the way that you create that dashboard, the first thing that you do is you've got to get your accounting system set up. If you don't have an accounting system set up, if you aren't tracking your numbers, you're not going to be able to see the readings or the feedback that your business is giving you. And you're not going to be able to make good decisions. You're not going to know what your sales actually are. You're not going to know what your expenses actually are. You're not going to know if you have enough cash to pay your bills. You're not going to know if your business is overly leveraged with debt or if you could actually afford to take on some debt. Some of these basic questions you're not going to know. You're not going to know what your best sellers are, what your worst sellers are, or what is making you the most profit. And the first step to doing that is getting your accounting system set up. And that involves bookkeeping and records as well. And the bookkeeping part of accounting is when you actually are handing over the records, which is all of your receipts and your bills and your invoices, to a person in an accounting firm called a bookkeeper. And they will actually do the recording or the entering into QuickBooks or a manual system for you or some other kind of system that's going to feed out that data to you in your financial statements, which we're going to cover in another webinar in a couple of weeks. And so that's just a little bit the brief statement about how to getting your accounting system set up so that you can have that financial dashboard, because the dashboard really is made up of your financial numbers, your sales numbers, and that's really what the starting point is. So I would encourage you to get that accounting system set up. Some other vital reasons for setting up your accounting system: hiring a CPA, getting your books going. Number one, just to save money. We all know that the more we track even our home-based budgets, our personal budgets, the more money that we save. And the same is true for business. The more that you're keeping track of what you're spending, the more money that you're going to save in the long run. Second reason is financing. If any of you are getting ready to apply for financing, the first thing that the bank is going to do or the investor is going to do is they're going to ask you for financials. And if you don't have them, you're not even going to get through the first phase of that process. And you don't want to wait until it's too late. The next thing is the unexpected. As we've all seen this year with the pandemic and last year with the pandemic, stuff happens. And a lot of businesses who didn't have their financials together, didn't have their accounting stuff in order, didn't get some of the grant funding that came out through the programs last year, because by the time they got all their books put together, it was just too late, or they caused themselves a lot of undue stress. Another unexpected thing, unfortunately, is, things do happen to the owners. Sometimes they go to the hospital, they get injured or hurt, sometimes even, die in the worst case scenario. And we want to have those financials together so that whoever needs to take on the business after us, usually kids or another family member, especially in the small business world, they need to have those good records to be able to understand the business and where it's at. So those passing on transactions can happen well. Fourth, taxes. If you aren't keeping track, you aren't going to be able to pay your taxes accurately, and generally you are going to overpay. And finally, if you ever want to sell your business, again, just like the banks, the first thing most buyers or potential buyers are going to ask for is your financials, so that they can put a reasonable value on your business and know that they're getting a fair deal. And if you don't have those finances together, usually you're either not going to be able to sell it at all, or you're not going to get as much money out of it as you possibly could otherwise. So those are other good reasons to put your accounting records in order and get that accounting system set up, in addition to being able to fly your business well. All right, so number two is for small business vitals is your gross product margin. So the reason this is so vital is because this is at the very core of what a business is, which is wanting to make a profit off of the products that you're selling or the services that you're selling. And the gross product margin is the way you figure that out. It's what indicates to you, or what shows to you, whether you're actually making money off of the product that you're selling. And it also allows you to calculate a percentage, or it calculates it for you in a percentage so that you can compare it across your product line to see how certain products compare to other products as far as how profitable or not profitable they are. So this is something that you can go and you can do immediately. For instance, if you're a product retailer, you can go and pull any product off your shelf, look at the retail price that you charge for it, and then go back at your invoices and look at how much you paid the wholesaler or the factory for it, and plug those numbers into this formula here, and it's going to give you your gross product margin. And so that gross product margin is simply the retail price minus the wholesale price divided by the retail price. And here's a quick example. So the gross margin, if you sell a product for $75, but you purchased it at market or from a wholesaler for $25, that's going to be $50. You divide that by your retail price, which is $75, and then your gross margin is 66%. So if on this product, whatever it might be, your gross margin is 66%, but you have another product that only has a product margin or a gross product margin of 33%, you know that this product is more profitable. You're making, $50 in gross profit off of this product, as opposed to, $25 or $30 gross profit on another product. You can do this across your product line, and you may even find one or two products that you're not making any money on or making very little money on. And so what I would do is, if I was you and I had a range of products that I was selling, I would go and do this calculation for every one of my products, figure out which ones are making me the most profit, which ones are making the least profit. And then I would compare that additionally to the quantity of each product that you're selling, and see what the most efficient product mix is for my store that I could potentially sell. So then you can go to market, you can go back to your wholesalers, and you can purchase more efficiently based on what you're selling and based on what your margins are. And that is something you can do immediately. It also helps you to monitor your spending. So if you're a manager, for instance, if you're running a restaurant, and you've got your accounting set up, you've got your bookkeeping set up, and you can see your financial reports, you can see your gross product margin on your income statement in your cost of goods sold. And if you have a kitchen manager who's purchasing, all of your produce, all of your meat, your supplies for your restaurant, every month you can go in and you can check what that gross product margin is for your entire product line. And so if you see, this month your gross product margin was 50%, but then next month it was 45%, and the next month it was 35 or 40%. But when you started up, you estimated your product margin to be 50 or 55%. Then something's going on in your kitchen. Either your kitchen purchaser who's purchasing everything is spending too much money, or you've potentially got a lot of wastage. And so as the owner, you can monitor the efficiency of your purchasing and your wastage through monitoring your gross product margin. You can also do this in the service industry. And if you're in the service industry, I'd love to be able to talk with you about that in more detail in a consulting session. You can also monitor your sales discounts. A lot of stores and services, you negotiate the price with your client, and you give your salespeople oftentimes, which is, many times you guys, in the case of our small business entrepreneurs, you're giving them discounts. So you give your salespeople authority to give those discounts. And you can see on your income statement, which we're going to cover in another webinar, how much discounts and how frequently you're giving those discounts. And so if your product margin or your sales margins are continually decreasing, you can tell that maybe your salespeople or maybe even yourself are relying a little bit too heavily on discounts in order to get those sales. And it can also trigger you to understand that if we might not be hitting our projections because we're giving too steep of discounts, or we're not making enough money to cover our bills because we're giving discounts so often at such a high rate. And as the owner or as the manager, you can monitor this through your dashboard if you've got your accounting set up correctly. And like I mentioned previously, thirdly, it helps you monitor your product purchasing and your sales efficiency. So you get the right product mix for your store. That's going to give you the most profit. So that's gross profit. That's gross product margin. And again, that's something that you can probably immediately leave this webinar and go and start working through if you want to. The next point that I want to hit briefly is what I call what is called the break-even point and the customer conversion rate. So what we usually go through with our entrepreneurs is we talk about, what's it actually going to cost for you to do this business? What are your fixed costs? What are your variable costs? And then how many customers are you going to have to close, or how many sales are you going to have to cover those costs? So fixed costs briefly are just the costs that you have every single month, regardless of whether you make any sales at all. So these are going to be things like rent, utilities, and payroll. So those are your fixed costs. Those are things that basically don't change, that you are going to have every single month, whether you make a single sale or not. So you can see, once you calculate your fixed cost, if you know that your product sold, so number 3 down there, or your average ticket, is $100 and your fixed costs are $1,000, then you know that you've got to have at least 10 sales just to cover your fixed costs. And then when you add in your variable costs, which are the costs that you only incur when you do have a sale, you can figure out how many customers that you've got to close if you know your average ticket price in order to cover those costs. And again, I'm just going over this briefly and would love to go over it more in depth with you for each of your different businesses, because as I was looking through today on our registrations, we've got businesses of pretty much every kind in here today, and I'd love to be able to go over those with you individually. So figure out your fixed costs, figure out your variable costs, and then figure out how many clients am I going to have to serve, or how many clients am I going to have to close on a sale in order to be able to cover those costs. And then once you know that, you can look at your calendar, you can look at the month that you're going through, and you can see how much work it's going to take you, not just to cover or to cover your costs or to break even, but what you're going to need to do to reach your financial goals above and beyond your fixed costs and your variable cost. Another thing you want to look at in regards to this is, we all know that not every customer who calls us on the phone and not every customer who walks in our door, we're going to be able to close on a sale. So for instance, if you have 10 clients walk in your door, and for every 10 clients that walk in your door, you close 1 on a sale, then you can project out how many clients do I need to get to walk in my door, or click on my website, or call me on the phone in order to be able to break even, or to be able to hit my sales goals. So you can figure that out, and you can see if it's going to take me, 10 sales to cover my costs, and only, 1 in 10 person actually purchases, then I've got to get, let's just say 100 people through my door or on my website just to be able to cover my cost. So that helps you know how much to invest your time in your marketing, your advertising, your social media spend, and those kinds of things. So knowing your fixed costs, knowing your variable costs, knowing your products sold and your average ticket price and your customer conversion rate will help you determine your break-even point and give you a better idea of what it's going to take to hit your goals. All right. The next big one is in the area of cash management. And the number one thing I like people to look at, usually just right off the bat to understand their business health, is we call it the quick ratio. And the quick ratio tells you 2 things. One, it tells you, can I pay my short-term or my near-term bills that are coming due pretty soon? And 2, it tells you how strong your cash position really is. So the quick ratio is this formula right here. It's your current assets minus your inventory divided by your current liabilities. So your current assets are generally any assets that you have that you can convert to cash or are cash within, 12 months. And it differs a little bit for every business, but that's what we call the generally accepted accounting principle, is short 12 months or less for current assets. Inventory and cash are both included in current assets. So to get that top line there, that current assets, that's your cash plus your inventory usually. So you'll just take that and you'll just subtract the inventory. And so that's going to give you basically your cash on hand. Then you're going to divide that by your current liabilities. And your current liabilities, just like your current assets, are all of the bills that you've got to pay or all the liabilities you have due within the next 12 months or shorter than the 12-month period. So if you take your current assets minus your inventory, that's going to give you basically your cash equivalents, divide that by your current liabilities or your near-term bills, and that's going to give you a ratio that's going to tell you how strong your cash position is and whether or not you can pay your bills. So here we've got an example. If you've got $40,000 in total current assets and you've got $20,000 in inventory, that's going to be $20,000 in current in your basically cash equivalents. And then let's assume you've got $12,000 in bills coming due or $12,000 in short-term liabilities for the technical term. And that works out to a quick ratio of 1.67x. So that would mean that you've got $20,000 divided by 12, 20,000 in cash is 1.67 times the amount of liabilities that you've got. So because that number is above 1, that means that today, if you had to pay all your bills with only the cash that you had on hand today, you could do it. And that's a great thing. And this is something you want to monitor on a regular basis. If that number ever drops below 1, that means that if you had to pay all of your bills today, that you don't have enough money to pay your bills. And quick tip, if you ever go to get financing in a bank or you ever need investment or anybody's ever looking to invest to purchase your business, this is going to be one of the first things that they look at. They're going to want to see if you're generating enough cash to be able to pay your bills on a regular basis, or if you're having to rely on things like credit and other loans for your cash needs. So you really want to pay attention to this. The second thing it tells you, as I mentioned before, is how strong your cash position is. The higher this number, the stronger your cash position. Usually, this number is very industry dependent. So if you're a restaurant, and you're in the food and beverage industry, there's a standard usually for what that number is. And we can help you see what that number is through some market research that we can give you access to. If you're in a service-based business or construction-based business, or if you're manufacturing something, all these different types of businesses and industries usually have a generally like a general average across that industry of what this number is. And so if you get in touch with us for a one-on-one, we can pull up the market research for you and help you know sort of where your business compares with this. But again, in order to get this, you've got to have your accounting set up and have good records. And that's cash management and the quick ratio. The next one is your accounts receivable average age or your collection period. So let me just kind of put this in as simply as I can why this is important and what this is. This is how long it takes your customers to pay you. So if you're in the food and beverage industry, most people pay you immediately. So this probably isn't going to apply to you. This is generally going to apply to our service-based industries. So if you're a doctor, or if you run a medical practice, or a dentist, for example, or if you're in the construction industry, a lot of times you'll close a sale with somebody and you'll issue them, but you won't issue them an invoice until the work is done. And then usually they've got 15 or 30 or 60 days to pay you. The negative thing about that is they aren't having to pay you immediately. And so in a way, you're financing them for up to 30 or 60 days or whatever those terms are. And so that's money that you're owed that you could be using that you don't have access to because they've got it because they haven't paid it to you yet. And so in the long run, that costs you more because you don't have that money to invest somewhere else in your business or to put in the bank to collect interest on. So you want to keep that timeline as short as possible. You want to collect as quickly as possible, but also balance that with service to your clients. So we want to keep this really, really short. And the way that, and if you are noticing that you're cash tight and you're not sure why, because you've got a lot of sales, but you don't have the cash to go with those sales, this is usually the reason why. It's because your accounts receivable average age where your collection period has gotten really, really long. We see this with a lot of medical offices because they're dealing with insurance a lot, and those insurance companies are really, very slow to pay. And as most of you know, and I know, when we go to the doctor, sometimes the bill doesn't even show up at the house till 30 days later, and sometimes 60 or 90 days later, which is kind of annoying, as you guys, I'm sure, have experienced. But it just seems sometimes like the bills keep coming. But in that industry, and generally, the age is very long. And the way that you can figure this out for your business, you can do your average accounts receivable for the period. So you could just do a year, you could do 6 months. 6 months divided by the net sales for the same period. So if we just take a year, you take your average accounts receivable for the period. So you just look at every month of your financials, and then you'd average out what your accounts receivable were for every single month. And then you divide that by the net sales for the year. And then you multiply that times the days in the period, which would be 365 days, as we've got right here. So if, for example, it was, $10,000, average out divided by $100,000 in net sales, you multiply it times 365, and that gives you an average accounts receivable age, or a collection period average, of 36.5 days. And again, just like the previous dashboard number, this is all the quick ratio, the 1.65 that we were looking at. This is also very industry dependent. So if you're a restaurant, this is usually going to be 0 because people pay immediately. If you're in the medical industry, sometimes this is going to be 30 or 45 or 60 days. If you're in the construction industry, it varies a lot, but there usually is an industry comparison. But the stronger your business is, or the shorter that usually you can, the shorter this period is. So on this number, the less it is, the better. So 0 is great. 90 is usually not so great, because that means you've got cash that's owed to you that's out there for 90 days or more sometimes. So you want to keep this as short as possible. And that's something that you can go figure pretty quickly as well if you've got your financials. So here's the last one we've got on deck that you want to do that's vital to your business is you want to do budgets, forecasting, and tracking. And you want to do this every single month. This is really key to managing your business well, to flying your business, to actively managing it. So creating a budget, you can simply do this with a pen and paper. It's just writing down. First of all, it's figuring out how much you have, in cash or assets that you can use, and then budgeting out how you're going to use that for the month. So it's allocating your assets. Number 2 is forecasting. And so that's predicting your spending and sales. You just want to sit down and say, okay, so next month, my rent is going to be this, my utilities are going to be this, my payroll is going to be this. I'm going to need to spend this amount in materials in order to produce this number of product, or I need to go purchase this amount of product in order to be able to sell in my store. And this is about how much I'm going to have to spend. It's simply forecasting what you're going to have to spend to maintain your business every month. And the third part of that is that every single month, you need to go back and you need to compare your actual spend to what you forecasted and what you budgeted to see if you were over or under in each of those categories. And by doing this every single month, you're going to be able to manage your business better, make better decisions, and spend money where it's going to be the most effective and get the most return on investment for your money. And again, I really suggest that you do that every single month. So that's all we've got. That's our 30 minutes. I would love to get into some questions. And you can ask those in the Q&A, or you can ask them in the chat, or you can hit your microphone if you've got it available to you, and you can just ask it out loud. Or if you just want to get a one-on-one consultation, you can just look in the chat box, and we've got our website listed there, as well as my email.
Hey, Scott, I think you did a pretty good job of covering the vitals. And so what we'll do, everybody, is we'll kind of hang tight for a couple of minutes and see if you have any questions. Like Scott said, feel free to chime in. You can chat, you can speak up. But I did post here in our chat, this is our website for ASBTDC, as well as how to sign up for a consult, or if you want to go direct to Scott, which some people do. And he is always happy to answer questions. So by all means, touch base with us there. I'm also going to post right now. We have a couple other webinars coming up here in the next couple of weeks in September. So like I said, this is the beginning of the fall financial series. And so we have one on the 9th of September and the 23rd of September. So just want to give you a heads up of what's coming down the pipe. So I'm going to pause for a quick second. Scott, you got one question about, can you recommend an easily accessible software to manage finances?
Yeah, so yeah, I mean, you can use something as simple as Google Sheets. It's free, it's online. If you're a new startup, small business, that's a great place to start, especially for your budgets and forecasts. And we've got some templates, and I can help you develop that. If you want to get a little bit more sophisticated and really track things, QuickBooks is really good for small businesses. There's usually a setup sort of session that is required with an accountant or with me to get you going. And there is a bit of a learning curve on that, but QuickBooks is really, really good. There's also other software out there that you can just do a quick Google search and do budgeting and forecasting template, or you can do budgeting and forecasting software. And some of those costs, anywhere from $9 a month to $20 a month. But I would just suggest a quick Google search for any one of those. But then honestly, if you're a really small business, just selling on Etsy or something like that, you could really do it by just pen and paper. So just really any one of those methods would be fine. But for more sophisticated businesses, if you're really looking at, making this, a source of income for your family or a fairly significant side hustle, would definitely recommend QuickBooks.
All right. Well, everybody, we want to thank you for being here today. Again, this recording will post on our website later on today, and you'll receive a brief survey that we would definitely encourage you to complete. These surveys help us continue to serve you by developing and presenting these quality programs that Scott just gave you. So you can find a full listing of all of our workshops on our events page at asbtdc.uark.edu, or you can scan the QR code, or you can sign up for notifications. And we'll post all this on social media channels. So please follow us on Facebook, Instagram, LinkedIn, and we look forward to seeing you again soon. Have a great day.